Do you or your client want to buy an investment property and conventional guidelines just don't fit or offer enough flexibility? That's where a DSCR loan can be a great tool. Let me tell you more about it. This loan is intended for individuals or LLCs whose income doesn't meet conventional standards, someone with less than stellar credit, someone who wants to buy a home in an LLC. They already own the max number for conventional financing and want to continue buying investment properties. They're self-employed and they just show no income, or they found a great opportunity, but the condo is non-warrantable. So how do these work? How do we determine if a loan will qualify for DSCR financing? Let me show you. One simple thing to point out, if the DSCR ratio is 75% to 1%, 25% down is required. If we exceed 1%, then 20% down is required. And what I mean by those percentages is the DSCR ratio is a ratio of monthly carrying cost divided by monthly income. So if the principal, interest, taxes, insurance, and potentially an HOA are covered by estimated rental income, we're at 1%. But the minimum is 0.75%, meaning that estimated rental income needs to cover at least 75% of the carrying costs to make the numbers work. So let's jump in. What I did here in Zillow is put in a scenario for a single family home with 4 bedrooms or greater and no HOA. We'll just click on this first property here, and I'm gonna round a little bit. So 460,000 price point. We'll leave it at 20% down for now. Estimated rent, let's see here, $2,800 a month. Taxes, let's pull that, $2,225 a year. Divided by 12, so $186 a month there. We'll leave insurance at $135 a month. That puts our DSCR ratio at 0.85%. So in this scenario, 25% down would be required. Let's say rental income were $3,300 a month, and that's determined by an appraiser going out and estimating the rental income on the home. You can see what the ratio does, and that would potentially give a buyer of this home the ability to put a little less down. So you can see the relationship there between price, down payment, the carrying costs, and then how this ratio works out. On the flip side of things, let's say the rental income were $1,850 a month. Our ratio would fall under that 0.75% and the numbers just wouldn't work. So it's pretty easy to plug in scenarios here and get an idea of if the property is a fit or not. So to reiterate, if you are a prospective buyer considering an investment property purchase and are looking for something a little less traditional than, say, a conventional loan, this can be a really good fit. Our motivations are aligned here as the lender, meaning we want to see that the property generates a very good amount of cash flow relative to the carrying costs and is in a very kind of cash flow healthy position, and we'll ensure that that diligence is done and that the property is set up to kind of succeed when that first renter goes in. I'm Michael Shotnik with Sierra Pacific Mortgage. We'd love to chat with you about it. If you want to strategize how you can talk to your database about this, if you're a real estate agent or if you're a prospective buyer, how this may fit, feel free to reach out and give me a call at this number. There we go. Anytime. Thank you.